I want you to think about the physical cost of your digital life for just a second. Like every time you type a prompt into an AI or, your phone silently runs a cloud backup in the middle of the night.
Yeah, or even just streaming a movie in 4K.
Exactly.
Yeah.
We have this pervasive habit of thinking of the cloud as this weightless, invisible, almost magical space. But the reality, the cloud is incredibly heavy.
It really is.
It's made of concrete, steel, silicon, and it requires a truly massive, staggering amount of physical electricity to function.
It is arguably the great illusion of modern technology. I mean, we've completely detached the digital action from the physical consequence.
Right.
But that physical consequence is currently reshaping our entire physical world, and specifically the power grids that keep modern society running.
And that is exactly what we are exploring today. We have a fascinating stack of source material for this deep dive. We're looking at an earnings conference call presentation from DTE Energy.
The major public utility company.
Right. Dated April 30, 2026. And our mission today is to look at this incredible transformation happening right beneath our feet. We're going to see how the absolute explosion of hyperscale data centers is radically reshaping the local power grid.
And doing it in some deeply surprising ways.
Yeah, ways that might actually end up lowering power bills for everyday people. Okay, let's unpack this because reading through this, a utility earnings call usually isn't this dramatic.
No, they're generally the definition of slow and steady.
Mhm.
You tune into one of these calls expected to hear incremental updates about power line maintenance.
Sure, or steady but modest dividend growth.
Right, routine infrastructure upgrades. But this April 2026 report, it reads fundamentally differently. Parts of this presentation look more like a Silicon Valley tech sector growth chart.
Yeah, it's wild.
What you're seeing in these pages is the collision between traditional, heavily regulated public infrastructure and the insatiable energy appetite of the tech industry.
So let's move from that abstract idea of the cloud down to the concrete reality of what these tech giants are actually demanding from local utility companies like DTE. The scale here seems fundamentally different from anything they've handled before.
Oh, absolutely.
I see references to a massive influx of data center load, but I really want to make sure we grasp the actual size of what's happening here.
The scale is astronomical. So DTE outlines that they already have a 1.4 gigawatt Oracle data center that is fully approved.
Wow.
Yeah, and it's currently under construction.
Right.
And on top of that, they just executed another 1.0 gigawatt agreement with Google.
And that one is pending, right?
Yes, it's currently submitted to the Michigan Public Service Commission, the state regulators, for approval. And DTE actually considers that Google deal an upside to their current long-term plan.
Wait, so they didn't even factor that Google deal into their baseline projections? And it's massive on its own.
It doesn't stop there either. The presentation details a pipeline of advanced discussions with other hyperscalers for another 2 gigawatts.
Another 2.
Plus, multiple other opportunities totaling an additional 3 to 4 gigawatts of new load. So if you add up the pipeline on top of Oracle and Google, we are looking at a potential 5 gigawatts of future demand just knocking on the door.
Are power companies basically becoming mega landlords for tech giants? Because adding a single customer who demands 1.4 gigawatts, that has to be completely different from adding a new residential subdivision. For context, how much power is 1.4 gigawatts?
To put it in perspective, 1 gigawatt is roughly enough to power a medium-sized city.
Oh my God.
Yeah, so about 750,000 average homes. So a single Oracle facility is demanding the electrical equivalent of an entire metropolitan area.
That's just nuts.
What's fascinating here is that this completely changes the traditional utility business model. It isn't just about selling a larger volume of electricity. It is a total re-engineering of what we call baseload demand.
Baseload demand. Break that down for us.
Think about how a normal neighborhood uses power. It peaks in the morning when people wake up, turn on the lights, make coffee. It drops off during the middle of the day when everyone is at work or school. And then it spikes again in the evening when people come home, turn on the air conditioning, and cook dinner.
So it's highly variable.
Exactly. It's a highly variable human rhythm. The utility has to constantly ramp power generation up and down to match that shifting demand curve.
And I'm assuming a server farm running AI models doesn't really care if people are asleep or at work.
It doesn't care at all. A hyperscale data center requires a massive, continuous flat draw of power. 24 hours a day, 7 days a week, 365 days a year.
So it never stops.
Never. For a utility company, that means you suddenly have an incredibly predictable, massive anchor tenant. It provides a level of steady, guaranteed demand that utilities frankly dream about.
But, I mean, you can't just plug a city-sized data center into the existing grid. The infrastructure has to be built. And looking at this report, DTE has had to make a massive pivot in how much money they are spending to upgrade their systems.
They've effectively had to rewrite their long-term spending plans. They had a prior 5-year capital investment plan for 2025 through 2029 that was mapped out at $30 billion.
Okay.
Now, their updated plan for 2026 through 2030 has jumped to $36.5 billion.
That is a $6.5 billion jump in a single strategic update. What specifically are they buying with that extra money?
The presentation notes that this increase is primarily driven by the Oracle project and their broader transition toward cleaner power generation.
So they have to build actual new power sources.
Right. To support these massive tech load ramps, they are detailing the need for up to 1,600 megawatts of renewable generation, plus 480 megawatts of energy storage.
Which is like massive utility-scale battery bank.
Exactly. And then also 350 megawatts of demand response.
I want to pause on demand response, because that sounds like jargon. What does that actually mean in practice?
Demand response is essentially a financial agreement between the utility and large industrial power users.
Okay.
So instead of building a whole new power plant for the few days a year, when the grid is completely maxed out, like during a massive summer heat wave, the utility pays large factories or commercial buildings to voluntarily turn off their heavy machinery for a few hours.
Wait, really? They just pay them to stop working?
Yeah, it's a mechanism to reduce the load on the grid during peak times, which is often much cheaper and way faster than building new generation.
That makes total sense. It's paying people to not use power when the system is stressed. But I see they're also building new physical plants. There's a note here about a combined cycle gas turbine to replace retiring coal plants by 2032.
A combined cycle plant is a critical piece of this transition. It's a highly efficient way to generate electricity. It burns natural gas to spin a turbine, much like a jet engine.
Right.
But instead of letting the exhaust heat just escape out of a smokestack, it captures that waste heat, uses it to boil water, and spins a second steam turbine.
Oh, wow. So you get 2 for 1.
You are getting 2 bursts of electricity out of the exact same fuel source. And DTE notes this specific new plant will have carbon capture capability, which aligns with their emission reduction goals.
Wait, hold on. I'm looking at this $36.5 billion price tag. If I am a local resident, this feels incredibly risky. Like, if the AI bubble bursts tomorrow or these tech giants figure out a way to run their servers on a fraction of the power and these massive data centers just go dark,
Right.
am I, as a local residential ratepayer, suddenly on the hook for a multi-billion-dollar empty power plant?
That is the most critical question a resident could ask, and it's something utility regulators heavily scrutinize. DTE addresses this risk directly in the presentation with some very robust financial notes.
Oh, okay. So they aren't just winging it.
Not at all. They aren't building this infrastructure on a handshake or a vague promise of future tech growth. They have established strict 19- and 20-year power supply agreements with these data centers.
So it's an ironclad lease.
It goes even further than a standard commercial lease. These agreements include minimum monthly charges, regardless of how much power the data center actually consumes.
Wow.
The capital investments themselves are right. The new solar farms, the batteries, the gas plants are covered by specific customized contracts. The presentation highlights a 20-year clean capacity acceleration agreement, for instance.
Meaning the tech companies are legally locked in to pay for the capacity, even if they, I don't know, invent a magical new microchip next year that uses zero power.
Precisely. The presentation outlines that termination fees, combined with very strict credit and collateral requirements, completely shield the existing customers.
That's reassuring.
If a hyperscaler wants this custom infrastructure, they essentially have to underwrite the financial risk themselves. They put up the collateral, which legally insulates the utility and the everyday residential ratepayer from the liability of stranded assets.
Here's where it gets really interesting, because addressing that fear perfectly sets up the most counterintuitive, surprising data point in this entire earnings report.
It's a huge shift.
We just talked about the fear of everyday customers paying for tech infrastructure. But the sources show that instead of costing residential customers money, these massive data centers are actively driving costs down for everyone else.
It is a remarkable economic dynamic. The numbers DTE presents to their investors are striking. They project that the Oracle data center alone will provide about $300 million of annual affordability benefits for existing customers once it's fully ramped up.
And what about the Google deal?
The Google data center is expected to generate about $1.7 billion in affordability benefits over the life of its contract.
That is staggering.
As a result of dynamics like this, DTE's total electric residential bill change from 2021 to 2025 was a mere 2.6%.
2.6%, and the national average during that same period.
Well, a staggering 24.4%. DTE's bills as a percentage of median household income are now significantly lower than both the Great Lakes regional average and the national average.
I was trying to think of how to visualize this for everyone listening. It's like you are moving into a really expensive high-end apartment building, right? You are worried about how much the rent and the building maintenance are going to cost you. But then you get a billionaire roommate who moves in and insists on paying 90% of the rent and the utilities. Because they're absorbing so much of the fixed infrastructure costs of the building, your personal share just plummets.
That analogy perfectly captures the mechanism at play. To understand why that happens, you have to look at how utility pricing actually works. A huge portion of your monthly power bill isn't just the literal electrons you consume to run your refrigerator.
It's the physical grid.
Right. It is the cost of maintaining the fixed overhead of the grid itself. The wooden poles, the high-voltage wires, the administrative billing systems, the baseline generation plants. That massive overhead is a relatively fixed cost that gets divided up among all the ratepayers in the entire system.
So when you add a massive new user who consumes the equivalent of a medium-sized city,
You are spreading that fixed overhead across a much, much larger base of consumption. Because these hyperscalers are guaranteeing massive, steady revenue over a 20-year period, your billionaire roommate is basically covering the lion's share of the grid's maintenance.
that makes so much sense.
The presentation even notes that this massive load ramp from the tech sector might allow DTE to delay its next electric rate case filing.
A rate case filing is when the utility has to go to the government and formally ask permission to raise prices on consumers, right?
That's exactly it. It's a highly regulated, deeply scrutinized legal process. But DTE literally might not need to ask residential customers for as much money in the near future because the tech sector is injecting so much guaranteed capital into the system to cover those fixed costs.
But all the affordable power in the world really doesn't matter to a customer if their lights don't actually turn on when a storm hits.
Very true.
We've been talking about these futuristic billion-dollar tech deals, but we need to pivot to the everyday reality of the physical grid, especially as the weather gets more volatile.
This is where the grand strategy meets the street level. Out of that massive $36.5 billion capital plan, DTE is fencing off $11 billion specifically for the electric distribution system over the next 5 years.
And the distribution system is the local stuff, right?
Yes, it's the final network of local poles, transformers, and wires that actually delivers the power to your house.
And DTE points to some major recent wins here. They report a 90% improvement in the duration of outages from 2023 to 2025.
That's a huge jump.
They also state they achieved their best all-weather SAIDI metric in nearly 20 years. And during a storm in January 2026, they restored 100% of impacted customers within 48 hours.
Which is incredibly fast for winter weather.
Yeah, and they managed over 99% restoration within 48 hours during a catastrophic storm in March 2026. Their stated goal going forward is to reduce power outages by 30% and cut outage time in half by 2029.
Right, and they plan to achieve that through deploying smart grid devices, increasing pole top maintenance, aggressive tree trimming, and rebuilding their legacy 4.8 kilovolt system.
Wait, let's look closer at those metrics. Because it is great that they are claiming a 90% improvement. But when a company touts an all-weather SAIDI metric, is that just a fancy piece of corporate jargon used to mathematically hide the reality of terrible storms?
I get why you'd ask that.
I mean, I know how companies love to massage statistics to make their quarterly reports look good.
It's a completely fair suspicion. But in the highly regulated utility sector, all weather actually means the exact opposite of hiding the bad days.
Whoa, really?
Yeah. So SAIDI stands for System Average Interruption Duration Index. It's the standard metric for how utilities measure outage length. Often, utilities will present to investors what they call a normalized metric.
Normalized.
In a normalized metric, they are legally allowed to exclude major event days like catastrophic hurricanes, tornadoes, or massive ice storms to show how the grid performs on a normal sunny day.
Ah, so normalized means they just throw out the worst data points.
Yes, normalized removes the extremes. But an all-weather metric includes absolutely everything. It forces the utility to count the severe storm days.
Oh, wow.
So achieving their best all-weather metric in 20 years means the physical grid actually held up better in reality, even when absorbing the worst possible weather events. If we connect this to the bigger picture, rebuilding a legacy 4.8 kilovolt system while actively managing major winter and spring storms in a state like Michigan requires intense, disciplined execution.
What does rebuilding a legacy 4.8 kilovolt system actually involve?
A 4.8 kilovolt system is an older, ungrounded style of electrical distribution common in older cities. It's really prone to cascading issues.
Like a domino effect.
Exactly. If a tree branch hits one wire, it doesn't necessarily trip a breaker immediately like a modern system would. Instead, it can cause severe voltage irregularities that stress the entire neighborhood circuit.
That sounds like a nightmare to fix.
Upgrading it isn't glamorous at all. It's grunt work. It means sending crews into alleys to replace old wooden poles, stringing new grounded wire, and installing modern smart switches that can automatically reroute power around a fallen tree.
And that is precisely why that $11 billion distribution budget is physically and financially separated from the data center builds. Regulators need to see that catering to Silicon Valley isn't distracting the utility from making sure a neighborhood's lights stay on during a blizzard.
Absolutely. The foundational job of the utility hasn't changed, even if their biggest customers have.
So DTE is shielding the consumer from tech risks, and they are pouring $11 billion into storm-proofing the neighborhood grids. But regulators don't just let you spend $36.5 billion based on a promise.
Definitely not.
Wall Street has to actually open their checkbooks to fund this, which means we have to look at whether DTE is actually making enough money right now to justify taking on massive loans. So if they are making all these huge promises, how is their actual bank account looking right now? Are they pulling in the profits to support this?
This is where we look at their Q1 2026 financial performance. In the first quarter of 2026, their operating earnings were $407 million, which comes out to $1.95 per share.
How does that compare to the previous year?
It was actually slightly down. In Q1 of 2025, they saw $436 million, or $2.10 per share.
Okay, so a bit of a drop.
The presentation notes this variance was mostly due to expected timing in their energy trading power portfolio and higher corporate interest expenses, though, importantly, that dip was partially offset by gains in their core DTE electric division.
Which was driven by colder weather and previous rate implementations, right?
Right, and gains in DTE Vantage, their non-utility business segment.
An energy trading portfolio timing issue? Again, that sounds incredibly dense. What does that actually mean?
Well, utilities don't just generate power. They buy and sell it on open energy markets to ensure they always have enough supply at the lowest cost. Sometimes they might buy gas contracts in December to use in February.
So it's just a cash flow thing.
Exactly. Because of how accounting rules work, the cash flow might look negative in January, but it balances out over the entire year. It is a known, expected accounting timing quirk, not a structural loss of revenue.
Makes sense.
That's why a slight dip in a single quarter isn't usually a red flag for a utility of this size, provided their long-term trajectory is stable.
And it seems to be stable because despite that Q1 dip, DTE reaffirmed its 2026 operating earnings per share guidance. They are projecting a midpoint of $7.59 to $7.73 for the year, which represents a solid 6% to 8% long-term growth rate.
It is solid.
But crucially, they stated they are confident they will actually hit the high end of their guidance range in 2026. How exactly are they pulling that off while spending billions on infrastructure?
They are leaning heavily on something called RNG tax credits to provide financial flexibility at their DTE Vantage division.
DTE Vantage?
DTE Vantage is essentially the arm of the company that handles custom non-residential energy projects. For example, they're building an upcoming 42-megawatt combined heat and power project for a specific industrial customer.
Nice.
And they have a fixed-fee energy solutions project with Ford Motor Company coming online in 2026. But the RNG credits, those are the real financial lever here.
So what does this all mean? RNG stands for renewable natural gas, right? Capturing methane gas from places like landfills or massive dairy farms and turning it into usable energy.
That's the one.
I just find it incredibly funny that in a presentation completely dominated by futuristic billion-dollar AI data centers and massive technological overhauls of the electric grid, the secret financial weapon that allows them to hit the high end of their targets is capturing gas from landfills. It's like funding a state-of-the-art mission to Mars by diligently returning aluminum cans to the grocery store.
It is a brilliant analogy, and it really highlights a fundamental truth about this industry. That dynamic is the absolute hallmark of a well-managed, diverse utility company.
Yeah.
They have to balance the high-profile, high-capital, future-facing growth like a 1.4 gigawatt Oracle AI deal with pragmatic, deeply unsexy operational levers.
Taking the methane off a dairy farm to balance the books for a Silicon Valley server farm.
It's all connected. They're leveraging those RNG tax credits and executing fixed-fee custom energy projects with legacy industrial players like Ford to maintain massive, steady cash flow. That unglamorous work is what allows them to maintain their solid investment-grade credit ratings.
Which is huge for borrowing.
The presentation notes they're targeting roughly a 15% FFO to debt metric.
FFO to debt. Funds from operations to debt. Let's unpack that for the listener because that sounds like pure Wall Street jargon.
Think of FFO to debt like that strong credit rating is the absolute foundation that lets them borrow the billions of dollars needed to build the grid of the future. You simply can't be the landlord to Silicon Valley if your own financial house isn't built on a rock-solid, diversified foundation.
It really is a fascinating high-wire balancing act. To bring it all together, the source material we've looked at today shows a public utility company standing at a historic crossroads. DTE isn't just maintaining neighborhood power lines anymore.
Not all.
They are aggressively expanding capital, taking on tens of billions in new infrastructure to meet the, frankly, insatiable energy appetite of the global tech industry.
Yeah.
But simultaneously, they're using the massive financial leverage of those 20-year tech contracts to shield their local residents from rate hikes. And they are plowing billions into upgrading the physical neighborhood grids to withstand increasingly severe weather. It is a total reimagining of what a public utility actually does.
It is a radical evolution. But as we watch this play out, this raises an important question for everyone listening to ponder long after this deep dive is over.
Okay, let's hear it.
If tech hyperscalers are essentially buying up massive chunks of regional power capacity across the country and directly subsidizing the public grid to do so, what happens to the balance of power in our society?
That's a great point.
When a local utility's financial health, their infrastructure planning, and their very business model become deeply, inextricably intertwined with a few global tech monopolies, who is really holding the keys to the future of our public infrastructure?
That is a heavy, essential question to walk away with. When the digital cloud gets so heavy that it literally reshapes the physical earth and the power lines in our backyards, we all have to figure out who is really directing the gravity. Keep questioning the world around you, and thank you for joining us on this custom-tailored deep dive.